I could call on Antonio Coletti and Chris Horton to take us to Europe and to explain whether in Europe the situation is any more or less confusing than it is in the US. And then I'm sure we'll have even more questions. Antonio, do you want to share your slides?
Yeah, so thanks so much for a fascinating sort of unpicking of SPACs. I think we're not here to comment on the sort of financial sort of aspects and who wins or who loses. I think for the next sort of 15 minutes, we'd just like to take you through how the SPAC wave, which has been very significant in the US, has made its way to Europe, and the particular challenges that we've been facing from a regulatory point of view in order to bring the US structures over here. But first of all, I think Antonio will sort of set the scene in terms of what we've been seeing in the US and then the comparatively low numbers of SPAC deals in Europe. Then I'll take you through some of the sort of legal issues we've been facing to replicate the US structures here. And then Antonio will take you through some of the stock exchange issues and what types of SPACs we've been seeing to finish off with. So quite a lot to cover in the next few minutes, so please bear with us. So that's what we're going to cover. So Antonio, do you like to just
Yeah, very briefly. I mean, I think the number explained themselves. Was really a boom of SPACs in the US, and you can see the trends starting from the beginning of 2020, and the average size of this transaction. That in the case of US, also at the time of the business combination, have increased their size through the pipe mechanism that has been described before. Next slide, please. So this is another slide about instead Europe, and you can say, I mean, and we can comment in a short while that in Europe, I mean, we have a wave also in 2016 and 17. Then there was a slowdown, and now there is a peak again. And the peak again, and we will explain in the next slide, is driven on one end by a flow of SPACs that are mainly established in the Netherlands and Luxembourg, but we see also some movement in local jurisdiction, and there is a reason that we're going to touch in terms of structuring the SPACs into Europe. And the other things that I want to notice, and they might eventually be touch base later on in the slides, is that in certain jurisdiction, there was a use of listing the SPACs on multi-trading facilities vis-a-vis regulated market. And obviously the reason around that, and we will touch base it, is because on this market there is they say there is no need to prepare a full compliant prospectus that need to be authorized by listing authorities, and obviously that is going to help in terms of time to market, and also obviously in terms of going through the process of review by a regulator.
So in terms of the features we're seeing in Europe, and again, I'll just pick out on a few things. So the trend from this SPAC wave, which you'd have seen from Antonio's slide, which is very small compared to the US, but it is building. In this latest SPAC wave, different from other ones in Europe, where we also have had some peaks in SPAC activity, the idea is to really copy the US SPAC features, rightly or wrongly, Michael. And so the types of features that we're seeing now in Europe are people are able to redeem their shares irrespective of how they vote. So for example, in Europe, it used to be quite common that only dissenting shareholders would be able to redeem their shares. But now generally people try and have it available to everybody. There is a vote to approve the acquisition. That's very common, has always been in Europe. Other than the UK, where we have a quirk of listing SPACs on a standard listing segment where actually a shareholder vote is not required. We also have another quirk in the UK where a company's shares, SPAC shares, get suspended when the de-SPAC or the merger transaction is announced. And that's quite unattractive for shareholders because they can't do all the things that they would do in the States, such as sell their shares or redeem their shares, etc. So that's something that the UK authorities have actually picked up on. And you might have seen that Lord Hill has done a review of the UK listing regime, and he's encouraged the UK FCA to launch a consultation paper to go through and change the SPAC rules in the UK, such that we will probably have redemption features and also have a vote that's mandatory, and to remove the suspension requirement. In terms of the unit composition, Michael, you talked about sort of units and the warrants and the shares. Again, we can replicate that in Europe. I think in the States, it's quite common to have 3 lines of listed securities for the life of the SPAC. So the unit trades as well as the shares and the warrants. Typically in Europe, we just have the units trading together for the first sort of 30 or so days. That's the stabilization period. And the underwriter likes to have 1 security to stabilize rather than 3. And after that, then typically the units automatically split into shares and 2 warrants after the stabilization period in Europe. We also have the trust account mechanism that you referred to, Michael. So often in the EU SPACs, the regulators require the cash to be held in a sort of trust account so that it's safe for the period of the life of the SPAC until the business combination or the winding up. Although that's not a uniform requirement. And just as a general observation, there's actually not really a sort of EU level SPAC regime. It's all sort of done as a mixture of the local listing rules and the sort of prospectus regulation, and how the relevant member states seek to fit the SPAC regime into that. So, perhaps one of the things that we are missing at an EU level is a sort of uniform way of treating SPACs. We also have the features for at-risk capital, so there will be warrants subscribed in order to cover the costs. They'll be provided by the sponsor. A big feature in Europe is that we have negative yield on the euro, as those of you with euro bank accounts will know. So you have to pay the bank 0.5% per annum for the pleasure of keeping your money. That is a cost. To date, the public SPACs in Europe have either made that an investor cost, so it comes off your €10 redemption. So, Michael, you can add that to the list of costs in Europe. Or sponsors have actually taken that and subscribed and provided additional capital to meet the negative yield cost. On the promote side, the promote in Europe tends to be more tiered. So perhaps there'll be 10% on the business combination, and then an additional 5% if the share price of the demerged or the de-SPACed entity goes above sort of 13, and another 5% if it goes above €15. So we tend to take more of an earn-out approach to the promote in Europe, which I think is possibly more favourable to shareholders. Then I just wanted to mention pipes, and that's come up a few times. So I think in the previous wave of SPACs in Europe, it's fair to say that the SPAC, I think generally, when it did an acquisition, would just spend its €200 million that it had raised, and it didn't really seek to raise more money. What we've seen in the States in this last wave is coming over here now. So pipes will typically be, or the sort of demerged company will be 3 to 4 times the size of the SPAC. That's the typical ratio of the target to the original SPAC. And so they would need to raise a significant amount of money through the pipe. They do tend, the pipe investors, to want to see sort of forward-looking information as part of their diligence to invest in the transaction. And therefore, I think, as Laura mentioned, it's usual to disclose forward-looking information. There is a sort of regime in the US that allows that to happen on a SPAC more comfortably than an IPO. We in Europe don't distinguish between a SPAC listing, sort of de-SPAC transaction, and a normal IPO. So therefore, any forward-looking information that has to be published to cleanse the pipe investors will need to go through the usual prospectus regulation regime. And therefore, potentially, there needs to be a sort of profit forecast if you're giving forward-looking profit numbers for the for the de-SPACed entity, and that will need to have the prospectus regulation mandatory disclosures around it. And then I think just, in terms of one other issue, it's not on the slides, but we have the Alternative Investment Fund Directive in Europe, and that requires that there is a sort of licensed alternative investment fund manager, and there are quite a few sort of marketing restrictions if you fall within that regime. I think that's just an additional regulatory requirement in Europe. I think generally most people are taking the view that a SPAC is not an alternative investment fund and therefore doesn't need to go through those extra requirements. But again, there's not a uniform application. So that's a bit of a whistle-stop tour of how we're trying to replicate the US structures in Europe. It is possible to get pretty close to the US structures, but every country is different. And talking of every country being different, I'll now go back to Antonio, who will just talk to you about some of the differences around the listing venues we're seeing.
Yeah, I'm aware that we are running out of time, but I think it's important to flag that generally, as you can see here, we have a selection of listing venue, and the rule of the listing venue in Europe are more or less the same. The reality, as Chris was saying, in order to meet the expectation to set up a SPAC that more or less is structured in a way that is similar to US SPACs, the reality is the Netherlands is taking the lead in SPAC entities, and somehow the Netherlands and the Euronext are becoming the point of reference for more widely European SPACs. So SPACs that have been set up by promoters that are coming from different European countries. That doesn't mean that we don't have SPACs in local jurisdiction like UK, Italy, or Germany. But for example, in Germany, they're using Luxembourg entities to set up SPACs, where for the time being in UK, they are looking at the British Virgin Islands for the relevant entities. But certainly, if we look at the European legal framework, the Netherlands is certainly the jurisdiction that somehow respond and adjust more rapidly to the market trends, and basically is allow SPAC promoters to set up entities that more or less replicate their US the US structure. Another consideration I would like to briefly make is that as you probably noted, and I was saying before, especially in UK and in Italy, in terms of listing venue, there was quite a few examples and precedent of SPACs listed on multi-trading facilities, like in UK and in Italy. As you are aware of, being the SPAC basically placed mainly and exclusively with institutional investors, listing on a multi-trading facility would allow to basically proceed with the listing document without preparing a formal prospectus compliant with the prospectus regulation and to be approved by the local authority, like the FCA in UK and the Consob in Italy. And obviously this is helping in some cases in the promoters to basically proceed quickly and get the right market windows for the SPAC. And even when they do the business combination, if the business combination would potentially trigger the preparation of a prospectus, the fact that the SPACs are listed on a multi-trading facility would allow basically not to go through the review the regulator and basically make a private transaction. The experience is that after the completion of the business combination, the new entity is then listing on the main market, on a regulated market. But obviously, in terms of flexibility, a multi-trading platform is obviously giving more flexibilities to the promoter. The downside of it is that the investor base can be slightly different, in a sense that, as we know, some investment funds and some institutional investors have policies that limit their ability to invest on multi-trading facilities. And obviously, in this case, the promoters, the choice of the venue can eventually be key in having the widest potential investor base. This is to complete our, I don't know if you want to go to the next slide, but the next slide is just a summary of some of the recent European SPAC that have been seen in the market to show where they've been set up. And on our end, I think we are prepared to answer any question, if any.
Thank you very much, Antonio. So I'm mindful of the time, but I think we can let me ask you maybe then one question before we go into the break. So if you look at this, you emphasized throughout your presentation that we are trying to come as close as possible to the US model that Michael has outlined. I mean, if you believe that there might actually be some market failure, or maybe there's actually some things in the US that are not so good. For example, Laura mentioned that voting has completely disappeared. Is that because it's private ordering and actually something that has evolved in free contracting and a good thing? Or maybe is there a market failure? So if you look at this very clear picture that you painted, is there anything in Europe that we might want to have that the Americans don't have from your perspective?
I will ask Chris also to respond. I think one of the key points is the ability of redeeming shares. In most of the European countries, there is a limitation basically, as Chris was saying, in some countries, if you are in favor of the business combination, then you cannot redeem the shares, when instead typically in US there is a separation between the two moments, so the consent vis-a-vis the redemption. And obviously that's a key factor because, for example, in Italy, the structure we have in place, the redemption cannot be more than 30%, where we know that in the Netherlands, but also in US, they can be almost 50%. And that's something that I think it's important flexibility for the investors.
Great. So let me thank the presenters in advance. I think we have managed to put 4 exceptionally clear presentations on the record, and they will be available for a while. I already saw one comment in the chat that this is gold. I couldn't agree more. So we've managed to bring together somebody from California, from Stanford, from London, and from Italy, and of course in Brussels, and I don't know where else, with emitting very little carbon. So this is really good. Now, of course, what would happen now in a in-person event is that everybody would go out to enjoy the coffee break. There would be very lively conversation, and it would be extremely difficult to get you all back into the room. Now, we do have now a 9-minute break. So I don't know whom you're going to talk to in the excitement that's been created in the first half, maybe to yourself. So enjoy the break, and we will be back. Please be back at 6:30 Brussels time sharp to continue with the panel, because we do have the CEO of Euronext here, and Jean-Pierre Mustier, who's actually thinking about launching. He's going to launch a SPAC. So we have people who are really going to comment on what the next steps are for Europe in this space. So thank you again, and I look forward to seeing you back in 8 minutes. Thank you. So welcome back from the break. If you've just joined us for new listing rules for SPACs and dual class, we are in the second half now, and we are going to have a panel session The panel is chaired by Luis Correia, who is the managing partner of Oxera. Oxera just completed a very substantial report on primary and secondary equity markets in Europe for the European Commission. And this really sets the theme. I think in Europe we are debating now what the future of capital markets is and the capital market union. Of course, the UK is now a third country, but I think we can also not ignore the UK because there continue to be links, and also, of course, there is regulatory competition, just like with the United States. So it's my great pleasure to turn over to Luis, who is going to moderate the panel and handle the rest of this session. Thank you, Luis.
Thank you so much, Marco, and good evening, everyone, or welcome to this panel session. It's a great honor to be here with you all on a fascinating seminar that ECGI has put together. Of course, the real stars of this panel session are my two panel speakers, and the first one is Monsieur Jean-Pierre Mustier, and he currently leads a SPAC called Pegasus Europe, and previously he was the CEO at UniCredit. The second panel speaker is Monsieur Stephane Boujnah, and who is currently CEO and chairman of the managing board of Euronext, the pan-European stock exchange operating a number of exchanges in Europe. So if I can just say a few words of introduction. European capital markets are at a critical juncture. In 2005, we did a study on the comparative performance of European primary markets versus US and Asian markets. And we found that Europe had been performing well at the time. The European exchanges in 2005 had raised more new money from initial public offerings and attracted more international IPOs than the US exchanges. You roll forward to the present day, the picture we describe in our recent study is very different. Some might even call it the decline of the public corporation. For example, the number of listings in the European Union 28 countries declined significantly over the last 10 years. European listed companies are getting larger and older. So to that effect, in the autumn last year, the European Commission published the CMU Action Plan, and some of the recommendations were focused on making financing more accessible to European companies. Many of these recommendations appear to be sensible and welcome changes. The question is whether this should be enough, and we will debate that, no doubt, later on. Two suggestions for stimulating European primary markets have been the increase in the role played by dual-class shares and new listing rules for SPACs. This panel will be discussing how far such initiatives can stimulate markets. As we go through the session, please post your questions in the Q&A. There will be an opportunity towards the end of the session to pick some of the questions and ask our panel speakers to address some of those questions. I will ask now Monsieur Boujnah to start his opening remarks, and then over to Monsieur Mustier.
Well, thank you very much. And I'm not sure you want me to focus on the capital market union, on the SPAC momentum, and maybe in the Q&A we can zoom on the two topics that are somehow related, but not really in a substantial manner. So what is true, and I will focus on the approach of SPACs, and I don't want to go back to the debates you had. I missed some of the previous presentation, but I listened to the one from Latham and the previous one that were extremely granular and specific. The first point I want to underline is that, which is common to the CMU and to the SPAC momentum. The reason why we are here today and the reason why there is so much interest for SPACs vehicles is that the fundamental driver behind that is the fact that any investment in interest rates yields at best zero, and in most cases negative yield after inflation and management fees. So basically, if you want some yield, you need to invest into equity. And behind everything we are discussing today, there is a huge momentum towards I need yield, and the only asset class that brings yields is equity, and people want to be exposed to equity risk. And therefore, there is a diversification of equity risk vehicle, and that's what SPACs are made for. It's an innovation in the context of refinement of vehicles available to be exposed to equity risk. It's just a normal step in the momentum that we are observing for 50 years, where in the old good days, people were investing either in bonds or shares, and then markets invented converts, hybrids, instruments, synthetic instruments, and now they are invented an hybrid product between a listed vehicle and a private equity firm. So that's the real thing that's why it's going to be sustainable, and that's why maybe there is a difference, and that's where I will differ somehow with the lady that made the point about the previous crisis and the bubble. Well, a bubble is not the same bubble when interest rates are negative, and that's the first point. Clearly, the second point is that we are facing now a new asset classes with fundamental differences between the US and Europe, but that has been covered extensively in previous presentations. But what I want to underline, and I think it was covered somehow before, but I'm not sure with the right focus, market trends are evolving. We are looking at a picture today, which is not going to be what SPACs will be in Europe in 18 months or 2 years. And because like any innovation, like IPOs in the old good days with underwriting fees, etc., things are evolving because months after months, investors are getting more and more familiar, more and more sophisticated. We are going to get soon to the first vintages of SPACs, at least in Europe, who will reach the critical asset time of decisions. And that's where when someone before said that sponsors are sucking value away from the asset, I think it's a very aggressive comment, because in any investment, you have some people who are being paid and remunerated to do things that investors, as consenting adults, are willing to pay. I mean, in a private equity investment, the partners in the management company get a carried interest, where you could use the argument that they are sucking value away from investors, etc. So I know it's designed differently, but clearly we have to be humble about the fact that many people in the planet wants to be exposed to the equity asset class, and that's the shortcut to be exposed to an equity investment. And clearly there are also so many differences in terms of skin in the game, which I think sometimes there is a simplification approach about 2 years, redemption, 20%. Well, the reality is that some sponsors are more exposed in terms of their own investment in the company than others, and that makes a great deal of a difference when it comes to how much you want to pay for the target company, and how inflationary in terms of pricing the assets the SPAC vehicle is. So clearly, and I want just to pause in a minute, we as exchanges, we want to be just facilitators of a financial innovation, which is natural in the interest rates environment I've described. Euronext Amsterdam, as you said, is one of the leading venues in Europe. Euronext, well, in the future, Euronext Milan or Borsa Italiana in Italy is after we close the deal, is also a very material player, and that was described, I think, by the Latham colleague before. And what everyone has to understand is that above and beyond listing rules, the real driver are corporate law, or to a large extent even tax law. I mean, people do list international SPACs in Amsterdam because of the flexibility of locating international companies in a quasi-English speaking country, where tax rulings are available in a very common way, and where corporate law is extremely flexible. So we should not confuse the corporate law and tax law environment with the listing the rules. And my final point is that any injection of equity is welcome. And everything is good as long as you inject more money at risk, more own funds in European companies. Where I would add a nuance to what has been said in the introductory remarks is that the trend is starting to reverse. I mean, the momentum of IPOs since the beginning of the year is just impressive. In the case of Euronext locations, we had the best quarter ever in terms of number of IPOs since 2015, which was an exceptional year. So the reality is, as I said, investors want more equity, so they invest in SPAC or they invest in listed companies, and companies are perceiving that there is an opportunity to raise own funds and equity. So things are changing. It's true that there is a concentration, but it's true also that the number of SMEs that are raising equity is starting to increase. And this trend is also accelerated by the significant participation of retail investors in the market, which is a new dynamic, which is absolutely fundamental. I mean, in Euronext markets, historically, retail investors were representing 2 to 3% of flows. In the course of a year, they have moved to 5 to 6. And the proportion of retail investors in IPOs, in SMEs IPOs, in technology IPOs, even in large follow-ons or capital increase is impressive. So it's not yet systemic, but something fundamental is happening among the retail investors. So the capital market union is a must-do, obviously, in terms of European sovereignty. I mean, everyone understands that in a post-Brexit world, the best thing that can happen to European companies is to get more equity. And to get more equity, we need to have more integrated markets with two pillars. One is the consolidation of market infrastructure, and we are one live example of what we do. We operate the exchanges of Paris, Amsterdam, Brussels, Lisbon since 2000, and in 2018 we acquired the Dublin Exchange. In 2019. Oslo Børs in Norway, and we have signed a few months ago the acquisition of Borsa Italiana. But in parallel to the consolidation of a sort of backbone of the capital market union, we must deliver together a regulatory pillar with an accelerator of the convergence on corporate law, on insolvency rules. I mean, the capital market union should be much more ambitious than a few twists or adjustment to market abuse regulations or the thresholds to what an SME is and what an SME isn't. And that level of ambition is absolutely necessary to get to a new level in a post-Brexit environment. But happy to take more specific questions.
That was excellent opening remarks, Mr. Boujnah. If I just hand over to Mr. Mustier, and then we'll pick up on some questions. Mr. Mustier.
Thank you very much, and good afternoon to everybody. Thank you very much for inviting me. I will not be able to speak specifically about Pegasus Europe because we have restriction because of Rule 144 in the US, as we are contemplating a listing, as you mentioned, very soon. This being said, I can comment on SPAC in general, but before I would like to take a step back and specifically focus about Europe and the need in Europe to have more growth capital, actually more venture capital as well. If you look at the comparison between Europe, the US, or Asia, we have actually a shortage of venture capital, which is very, very clear, but also of growth capital in Europe. And there's a very simple ratio to use, which is the market cap to GDP, which in Europe is around 80%, while in the US it's around 180%. And so we have a very big difference between countries. I think France could be around 85%, Germany 57%, and Italy 37%. And so it does mean that versus other jurisdiction, Europe needs more growth capital. There was a very good study made a few years ago in 2015 by the BCG on behalf of AFME, which was explaining why we have such a difference between the US and Europe, is specifically 60% of the difference in terms of gross capital availability, the market to GDP, can be explained by the lack of risk investment by pension fund or lack of pension fund in Europe, and the lack of risk investment by insurance companies, especially life insurance companies. And I assume we'll discuss that a little bit later when we cover the CMU side. And so we need more gross capital. And when I used to work in UniCredit, I was meeting entrepreneurs in Italy, Germany, Austria, and once or twice a day. And each time I was mentioning to an entrepreneur, do you need patient minority equity capital to fund your growth? They always said yes. So entrepreneurs need patient minority equity capital. And there are some funds or private equity funds which can provide that, but very few. Private equity is not an answer for patient minority equity capital. Usually they have 5-year horizon. It's not very patient. Usually they want to take control. They are not minority. Few funds do. General Atlantic, HLD, TKO, who is one of our sponsors, provide long-term capital because they have long-term permanent capital and they can provide that. But usually the private markets cannot provide that. And on the public market, I mean, IPO can allow these entrepreneurs to have a minority equity shareholders. But the IPO process is very complex for an entrepreneur. Might not be used to all the listing rules, might not have yet the governance to do that. And the SPAC are actually a very complementary product between the private market on one side and the IPO on the other, in order to help these entrepreneurs to come to the market. Why? Because it simplifies the process greatly. It allows, if the sponsors agree, to have for the entrepreneur the support to be able to travel, all the capital market issues and be helped in terms of governance, in terms of the capital raising issues, in terms of the organization of the company, in terms of the investor relations side. So in fact, a SPAC can be extremely useful in order to bring more patient minority equity capital to Europe. And I think that's something which we really need to consider. I mean, clearly we have listened to statistics about the US. The way to present them is absolutely correct, but the reality that you need to look at SPAC in a different way is that a business combination, meaning the merger with a SPAC, needs to be done in such a ratio that the dilution impact coming from the SPAC, which has been rightly pointed out by the two presenters initially, will be much less than what could be the discount of an IPO. So for the shareholders, the subsequent shareholders of the business combination company, who are the one bearing the dilution, not the SPAC shareholders, and I slightly differ with the view of Michael here. If the SPAC combined with a company which is 4 or 5 times its value in terms of equity value, then it is actually more favorable than an IPO when you compare everything which has to be compared. In terms of the specificities of the SPAC, let me comment very briefly to complement what Stephane has been mentioning about what could be the difference between different jurisdiction, not only listing places, as we have in Europe not yet harmonized incorporation characteristic. And so there is a big difference between the Dutch corporate laws, the French, the German, or the Luxembourg, for instance. And in Holland or in Luxembourg, in terms of corporate law, there is ease of preemptive right exclusion. So, and I think that's important for a SPAC or for an entrepreneur, that the preemption right can be managed in a more flexible way when there is a need of a capital increase, and it's as well important for a SPAC as we do capital increase through what we call the forward purchase agreement, which is subscribed by the sponsors, or through by private investment in public equity. So ease of preemptive right is something which is a difference between different jurisdictions, we're speaking about corporate law. The second thing which is useful can be directed share buyback, which for SPAC is important, especially when there is a redemption, as the shareholders of a SPAC have the right to redeem their shares if they disagree with the business combination, as was mentioned. And there is here, I mean, something that's very useful for the SPAC. There is ways to go around that, for instance, under French corporate law, but which is not always easy. And we, I mean, of course, have the opportunity or the issue of a dual class. The dual class can be easier to implement in specific jurisdiction, for instance, in Europe. And then there is question, of course, about dual class, maybe excess on one side, or looking at a different clause, a sunset clause for the dual class shares. And I'm sure that we'll speak about that tomorrow. But here, I think we need to look at the point of view of an entrepreneur. An entrepreneur wants to grow a company. They might be doing acquisition, so they might issue more capital to do their acquisition. It seems fair to allow them to be able to remain, at least in terms of negative control, so having more than 33% of the voting rights if they dilute themselves more for a certain period of time. So I think the dual class share structure, is something which could actually help entrepreneurs look at acquisition by diluting themselves, issuing more capital. And these entrepreneurs, remember, the SMEs in Europe represent between 70 and 80% of the job. So it is our interest to make sure that we help them grow their company. In terms of listing rule, we have a certain number of differences. I mean, clearly, Amsterdam is more neutral. They are more used to SPAC, and in other jurisdictions, and post-Brexit, we can comment maybe about London, which is trying to catch up with Amsterdam or others. But in London, one of the most prominent issue and difficult issues for SPACs, as it was outlined before, is the suspension of trading until there's a prospectus issued where there is a business combination. So to summarize, I think that Europe needs more growth capital. It can be provided by different instruments or players. The SPAC is one of the alternatives, and actually a complement to private capital or the IPO could help the entrepreneur do that. And to come back on what was mentioned by the first two speakers, it's clear that we need to make sure that there is a very strong alignment of interest between the SPAC sponsors and the shareholders in the SPAC, but they can always redeem their shares at par, but with the business combination company, more importantly, so that the sponsor of the SPAC can remain long-term shareholders of the business combination company, which ensure full alignment of interest, specifically if they invest a meaningful amount in the SPAC and the business combination company. And I stop here.
Very, very good, Jean-Pierre. Really succinct and lots of information. I'm going to ask a question first about the CMU action plan, then one question on dual class shares, and then one on SPAC. Like that, we cover sort of three key topics. The first one on the CMU action plan. Do you think? And I think Boujnah has started to articulate some answers to that. But do you think it goes far enough to stop the decline of public equity markets in Europe? Perhaps Mr. Boujnah, you can continue on that, and then Mr. Mustier can add some observations on that.
First of all, I don't like the phrase the decline of listed capital markets in Europe, because this is not what we're observing. I was just telling you that something very fundamental is happening for the past 6 months here, which is the return of IPOs, the return of retail investors, and clearly the return of equity everywhere. So no, I think the problem with the Capital Market Union is that sometimes, and I was a member of the high-level forum set up by the European Commission to advise them on the next agenda for the Capital Market Union Season 2, sometimes there is a tendency, the Commission, to produce ideas or rules that are precisely wrong rather than roughly correct. And really, the level of ambition is not where it should be. In my view, The real game changers are insolvency rules. I mean, if we could have the same insolvency rules across the continent plus the Republic of Ireland, then all sorts of consequences will be deployed not only in the fixed income class, but also in clearing, in everywhere where there is any form of counterparty risk. And the other aspect is corporate law. Basically, as long as there is an arbitrage in terms of dual class shares or the possibility to make your corporate communications in English language, etc., then some places will look, smell, and sound more international than others. In terms of substance, I'm a big fan of being ambitious on two things that seem to be below the radar screen, but be outside the radar screen, but are very important. The first one is a simplification ambition or simplification test, and the second one is a competitiveness test. Basically, if the Commission, after any idea that is put on the table, would just use a sort of a last look or sanity check, which is, does it make Europe more competitive or less competitive? Does it make Europe more a finance taker, or does it make Europe more a finance maker? Then you will have a very strong filter about what is appropriate and what is not appropriate. And the second one is a simplification test, because what is fascinating is that market participants love capital market union when it makes their life simple. Because you know what? They are just like any Europeans. We as Europeans, we love Europe when in the 50s, when our parents were able to buy a washing machine much cheaper from Italy, or German cars, or French food, or when later on we were able to use the euro currency or to cross the borders with Schengen agreements, etc. And the market participants love the single market with the freedom of establishment and these sort of things. What they don't like is when, for the sake of integrating the markets, you pile up layers of reporting obligations, and to a certain extent, market abuse regulation has been one of these typical examples of a set of measures that, in some cases, on some aspects, are precisely wrong rather than roughly correct, because there was a total loss of control about the balance between incremental impact in terms of protecting market operations versus the pre-existing rules on market abuse versus the incremental burden on reporting. And that's why a significant part of the efforts on the CMU is about correcting, adjusting, twisting the unwanted effects of the previous European regulation. So you spend a lot of time negotiating things and then trying to amend them and creating the right level of flexibility. So I think the ambition should be much bigger, especially in a post-Brexit environment where our neighbors across the water have decided or are invited by the report of Lord Hill to put competitiveness as part of the mandate of FCA. So the ambition should be definitely stronger.
So Mustier, do you want to follow up? In particular, you mentioned the pension fund and insurance firms' investment as quite an important dimension in stimulating public equity markets. Perhaps you can pick up on that?
Yes, well, maybe let me make a preliminary comment. Of course, the Capital Market Union is a very good initiative and we all need to support it. So the point is, I think there is one missing element in what the Commission is working. It's the investors. The Capital Market Union focuses, has always focused on very technical issues, the prospectus directive, a certain number of other technical issues, but they forget about investors. And the capital market is made of issuers on one side, but on investors on the other side. And as we mentioned and commented earlier, we need growth capital in Europe. So we need more investors providing this growth capital. There has been in the review, in the 2017 midterm review, there has been a certain move towards more investors, like what the development for venture capital and social entrepreneurship, where the Commission is ready to support the creation of fund of fund, for instance. And you have seen, but 5 years after the launch of the Capital Market Union, that we've got from EOPIA in December, the final review of Solvency II in order to see if insurance companies could take more risk, more equity risk. It took 5 years. So I think that what the Capital Market Union needs to do, in addition to the very good things that they've been doing and pushing, is find ways to encourage more growth capital or risk capital to be invested. Now, there has been the change, and that's for the 2017 midterm review as well, on the increase of personal pension product, the PEP product. That's a very good development as well, because we need more long-term capital to be put there. But there needs to be more focused. And then the Commission is a little bit in a difficult situation, because some of the development to attract more investors are not only something which can be regulated by the Commission, but are also something which depends on each individual country. Pension issue has some tax implications, so it's more a domestic issue than a European issue per se. So we need to move more on that and make sure that we might actually downplay a little bit of some of the technical issues, specifically when the Commission was focusing on splitting the borrowers from the banks. That, I think, was a mistake. I mean, the Capital Market Union should not have been focusing on that, because borrowers in Europe need banks. Usually the SMEs need banks. The capital market are too big, or the SME issuers are too small to tap the debt side. And the Commission should focus even more today with the very good thing that they've been doing, promotion of SME growth market as well, in terms of listing requirement, but more to bring more investors and growth capital. That should be my comments.
That's great. Can I just sort of move quickly to the dual class shares, and do you think that the changes, the discussions that we're having at the moment about making dual class shares more available for listed companies, do you think that will be that is sufficient to attract more listings? Which one of you would like to offer some observations?
I mean, dual class shares are a very fundamental part of the corporate law DNA in countries. I mean, it's so difficult for countries. There is a whole legal environment, ecosystem around dual class shares. In France, you have double voting rights after a certain period of holding of the shares, etc. The Dutch guys are much more creative and flexible. I mean, it's very, very, very difficult to create from scratch dual class shares. Look, the Lord Hill report proposes maximum thresholds for 5 years, etc., which are very ambitious, but there is just addressing one part of the issue. But where you put the needle and the compromise between protecting the existing shareholders or the non-sponsored shares is really key. So I'm not sure it makes a huge difference. The development of, I mean, we had this debate years ago about the development of technology companies and the listing of technology companies. It turned out that sponsors or initial investors list technology companies on the basis of where is the actual critical mass of comparable companies, where is the location where you have the equity research analysts, which are numerous enough to cover the stock. And it is much more relevant than the corporate features of corporate law. So it's good. It drives a lot of attention, but in my view, it's more a nice to have and a must do than anything else.
Just to complement what Stephane is saying, I think first of all, the choice of the listing venue is not only driven, as Stephane was mentioned, by technical issues. I mean, of course, many people are focusing on technology company. It's clear that the valuation is not the technicalities or the dual class shares or the technicalities which make the difference. And the valuation in the US on specific segment can be higher because you have more money to be invested. But for a European company to invest in the US is extremely risky. I mean, first of all, you need to go through all the Dodd-Frank issues. If you're a company which has no core business in the US, you're going to be an orphan. You're not going to be followed by the equity analyst. Investors are not really to invest in your company. So investing in the US has to really, really be well considered by any company and find the right justification. And if there's only a marginal valuation difference or not at all, they need to list in Europe. That's very, very clear. So that first of all, and so I'm making a little bit of advertisement for Stephane and Euronext here, but I think it's important. The second thing which is important is that for dual class shares, as I mentioned earlier, entrepreneurs, and we're not speaking about tech companies, we're speaking about all entrepreneurs. For them to decide to list, they need to feel comfortable that they will have some kind of control, and I will elaborate on that, on their company when they keep growing, they keep issuing more capital to grow. And dual class shares are a good answer. But dual class shares are also an answer, as Stephane mentioned, for long-term investors. We need long-term investors in Europe, because otherwise, you are going to have only short-term investors, momentum-driven, who can't care less about the 2, 3, 4, 5, or 10 years evolution of a company. And that's what you need. So to reward investors with more voting rights, because they have a long-term view, in order to support the strategy of a company, is absolutely fundamental. Otherwise, company will be under the diktat of short-term investors who are just following a momentum, are selling out, and can't care less about what should be the future of a company. We need to reward them, and this is extremely important. So interest of entrepreneurs, interest of long-term investors have to be taken into account, and dual class shares are the answer. We need to avoid excess. I mean, of course, if you have massive excess of multiples of voting rights, that does not work. We could have as well some sunset clause. I mean, Lord Hill proposal include that, which could be looked at, but I'm not completely comfortable about it. But I think they are a full part of the arsenal of instruments that we need to consider to bring more capital and gross capital to Europe.
Excellent, thank you. In terms of the SPACs, I think there's an excellent question that has been posted, and I'll just read it out. Wouldn't it make sense to restrict investments into SPACs to professional, qualified investors, which are understanding the risks and costs?
This is already the case in France.
My answer is yes.
Yes, this is already the case. This is one of the most structural differences with the US. I mean, there are plenty of reasons why the concept of bubble doesn't apply this time as a shortcut, as described in one of the previous presentations. The first one is that you don't characterize prices in the same way when you have this level of monetary stimulus that has been injected over the past 5 years, and second, or past 2 years, sorry, and the second one is precisely the point you just raised. So I think we are in a situation which is radically different from the US one. And the other point I want to insist on is the skin in the game. Jean-Pierre cannot comment on his own SPAC, but I can because it's public. But the fact that the two corporate sponsors and the two individual sponsors together are going to inject in his project 160 million is a fundamental difference with SPACs where a couple of sponsors are injecting together 5, 7, 8 million euros. Because the big risk from an investor point of view is, okay, I'm writing a blank check. Okay, the money is in the escrow account, but they say they have only 2 years to make the investments. Are they going to overpay and to rush on anything to to spend the money instead of investing on a profitable venture. When sponsors have a skin in the game, that's a big difference, because they just can't afford to burn cash, because this is their own money. And I think this is also one of the big difference between the European environment and the US environment.
So Mustier, anything to add on that point, or shall I move to the next question?
Let's move to the next question.
Okay, there's a really good question. It's quite general, but it sets the scene really nicely. What is the challenge for the future? A, much more liquidity on the market. B, prevent crisis. C, legal capital requirements. What is the challenge for the future?
For whom?
Well, that's very
for whom? I mean, for
very good question.
For a bank, for an investor, for whom? I mean, there is no free lunch. Protection from someone is a constraint for the other. So for whom?
I would say, from my point of view, is there's one thing which is missing for the challenge for the future, and the biggest priority for me is to make sure that all participants have a long-term view. And that's absolutely key in order to create value and protect investors. That starts from the governance of a company, that starts from the board of a company, that starts from the managers of a company, which need to have a long-term view and not a short-term one, in order to please investors short-term, for the next quarter, or take actions which are not going to basically bear long-term benefit, but only short-term benefit, and which can reverse afterwards. It's true as well in terms of ESG. If you take a long-term view, you can take short-term measures which can be negative for a company because you decide to exit businesses or you decide not to do things, but they are extremely important for the long term. And so I think the key, and actually the key in order to make sure that all stakeholders are aligned, is when everybody has a long-term view, the management of a company, the board, the investors, for the benefit of all the stakeholders. And for me, that's the key absolute priority. The rest is more technical, if I may say. The long-term view is the fundamental issue.
Great. One last question for each one of you. Boujnah, you mentioned about the reversal of the trend, and I completely agree. We've seen some really kind of reverse more recently. Do you think that trend is here to stay? And the other aspect of what you said around the retail investor participation, do you think that trend is here to stay? And then to Mustier, the question is really, do you think that the SPACs trend is here to stay? So question for each one of you. Who wants to go first?
No, I think this trend is to stay for the very fundamental tectonic reasons I mentioned earlier on. As long as you don't make money anywhere except in two asset classes, equity and emerging markets bonds, and emerging market bonds is a rough sport, not available to everyone. The only asset classes where you can get some form of yield is equity. And for sure, when you belong to the happy few, you can invest in private equity. But there are some people in the planet who need to get some liquidity, where liquidity is not just a nice to have, but it's a must have. And therefore, public equity is going to boom, and is already starting to boom. I mean, we have, irrespective of the volatility of 2020, we are seeing a significant increase in the volumes traded in all venues, because this is where people make some form of return. In addition to that, investors, private investors, retail investors are back for a combination of reasons. First of all, they got for several quarters their returns from their insurance companies or pension funds, and they realize that whatever is invested in fixed income is leading nowhere and that they are losing money. But on the top of that, COVID has changed completely the behaviors of retail investors. I mean, what has been observed across Europe is that when people were locked down in the first lockdown in let's say 1 year ago, they were stuck in front of their screens. And among the funny things you can do in front of your screen, one of them is to trade in a very easy way. And what we observe is that the profile of the new retail investors is fundamentally different from the previous generations. I mean, they are much younger, much more connected to the companies. Even if the GameStop story cannot be replicated in the same way in Europe as in the US, the drivers behind the GameStop coalition behind certain stock exist in Europe in a different form. So I think we have to get used to the idea that equity is back for long, and we are to get used to the idea that retail is back for long.
Thank you so much, Mr. Boujnah. Mr. Mustier, on the SPACs trend, and then I'll hand over back to Marco.
I think, as I mentioned, we have structurally a need to bring more gross capital to Europe. So each of the components which can allow to do that are here to stay. And the SPAC is one instrument between the traditional IPO and the private capital. So clearly, this instrument is useful. And if it's useful, it will be needed. Of course, there could be amendments or improvement in the structure of the SPAC, but I have zero doubt that SPAC are here to stay, to bring this additional capital to entrepreneurs, and together with the private capital and the traditional IPOs.
Thank you so much. And on those two very positive notes from Monsieur Boujnah and Monsieur Mustier, a huge thank you to the two of you for extremely insightful observations and for sharing your thoughts with all of us. It's been a real pleasure.
Thank you for inviting Pegasus Europe. Thank you very much. Bye-bye.
Thank you, Luis, and thank you, Stephane Boujnah, and thank you, Jean-Pierre Mustier. I thought that was fascinating. Of course, Euronext is a very unique market in the world, with having multiple jurisdictions being combined in one market in the European Union. So we're going to watch, of course, how this evolves as you said, Stephane, as things progress, because what will be in 18 months is probably not what we have today. And I also thought that on Jean-Pierre Mustier, it's going to be very interesting to see whether the vision that you outlined, how that's going to play out, because we of course had listed investment trusts and closed-down mutual funds that tried to provide patient minority capital with minority positions in the past, but they traded at a discount. So it will be really interesting to see how this works out and if it comes about as a SPAC. So it's now my task to wrap up with, in the company of my colleague Tim Jenkinson from Oxford. Tim is really an expert on private markets and private equity. And one thing that Jean-Pierre Mustier said at the end really struck me also in the previous presentations, that is that SPACs really do have, we compare them to IPOs, but they also have a lot in common with private equity, because you raise money to buy other companies, but you don't raise it from private investors in an LLP. You raise it in a special purpose acquisition company with money from public markets. So that's really a difference, and the time horizon is different, but in the nature of it is actually quite similar. So I'm really looking forward to hearing what Tim has to say on this. And also Tim has done research on the previous wave of SPACs. So Tim, what are your thoughts after the first half and now the panel that we just had?
Yes, I thought there's some fascinating papers and discussions, and I would really pull out maybe four things that I would focus on here. I mean, the first question to me is like, especially on the SPAC question, which I'm going to focus on the whole, sort of why do we care about SPACs? Why are they important? And I think there are maybe a few different reasons for that. For one thing, which hasn't really come up so far, is actually that it impacts on the geography of listings. We see a lot of companies, Chinese companies going and listing in the US. We see European companies, some of our best, most innovative European companies ending up on US markets, reversing into these SPAC pools of capital that have been raised on US markets. And this could have quite a big impact upon the resurgence of public markets. As we know that, you know, in many countries, in particular in the US and UK, the number of listings has been going down pretty dramatically. This is reversing that trend, and it might be quite important in the way that markets or the types of companies that markets get known for. And so there might be something very galling about a leading European tech company developing and then going over to the US because there's easy SPAC money available that isn't available in Europe. And so I think that's, if you like, one reason why we care. I think the second reason why we care is because we know that especially for entrepreneurial ventures, the availability of the exit route is really important to have a good ecosystem in the first place. And SPACs provide an alternative exit route. Now I'll have a few comments about why that could be attractive, even given what Michael said, and I'll have a few views on that. But I think it's another route, which is in some ways always good, right? It's always good to have another exit route, and so I think it's important from that perspective. And I think the third reason why we care is because it's probably telling us something about the IPO process, because in some ways it does stick. It is an exit route, and we know that there are certain elements of the IPO process which are not very attractive to investors. We know about the direct costs in the US. Of course, the direct costs are normally about 7% that you pay the underwriters, less in Europe. We know about underpricing. We also know about the various conflicts of interest scandals that we've seen, which mean a lot of entrepreneurs sort of don't want to, in their minds, you know, sort of feather the nest of Wall Street as opposed to Main Street. And that's been, I think, one of the reasons why we care about this, because it may be telling us something about the IPO process itself and its efficiency. And I think that one other area that I think is important here, which we talked a little bit, or I heard a little bit about, but I think is actually really important, is that it could be the case that the sorts of information you can have available for a SPAC when it goes to the public market is better, because you can have forward-looking statements. So a lot of these, you know, technology ventures where you're coming along with a, you know, I don't know, flying taxi company or something, you can project what you think that market will be worth to you, and public investors can see that, whereas in an IPO you can't. So I think it has various interesting regulatory issues about the type of information that could be made available in prospectuses, for example, at a technical level as well. So those are, if you like, why we should care about this. And I think there's many good reasons why we should care. The second point I wanted to make is a sort of obvious one, but is to succeed, these are very expensive, dilutive vehicles. So to succeed, the SPAC promoters have to find a really good deal, and they have to negotiate a really good deal. Otherwise, they will lose money. And I think
and if I could just interrupt you there, because that's the bit that I really didn't quite understand. So it's not that the SPAC is bidding, it's the only bidder in the world when they make the acquisition. I mean, there are other people who might want to acquire the same target. I mean, they are in competition with other companies. They are in competition with private equity. Maybe they're in competition with other SPACs. So if these SPACs are so expensive as a funding vehicle, you know, how come that they can still offer competitive prices for the companies that they're buying? I mean, you know, where's the magic money tree here? I mean, this is the thing that, you know, I mean, it's a competitive market, presumably, or is there some inside deal where they already agreed beforehand with the company that they are acquiring some kind of side payment, or what's going on?
No, I think I mean, in principle, there could be some side payments. And indeed, in some of our early studies, we did find a bit of that shenanigans going on. But I think that that's not very common and probably not happening in the current wave of events. I think that, you know, a lot of the capital involved here, this sort of private capital, is very expensive. If you add up the costs of a private equity fund, you're paying, you know, up to 2% a year for 10 years of a fund. That's 20%. And then you've got 20% of the profits going to the private equity fund. So capital is quite expensive here anyway. And you've got to, so in a way, the SPAC is expensive because it's 20% of the equity. And that's a big difference, because you can get rich as a SPAC promoter by losing money for your investors. And so there is a big difference here. But I think that in both cases, in private equity fund cases or in the case of these SPAC promoters, they've got to add some value. And that could be striking a good deal, or it could be saying that we have particular skills, which when we combine it with this firm, and we're going to stick with them for the next 2 to 3 years, we're going to make you money. And you've got to sort of believe that they can add value themselves, which is why I think SPACs are very much like, you know, the sort of rock stars of the corporate world can raise SPACs, because they say, you've got to trust that I can make good money and it's on my back and it's my reputation at stake. And so I think you have to understand them in that way. But it is a hell of a headwind that you're going into in this situation.
So this is essentially the positive spin private equity argument, which is that private equity brings expertise that these companies don't have, and you know, they actually add value. So this would be your hypothesis, so that these SPAC promoters have something very special that they bring, which would be in line with, you know, Michael distinguishing between the high quality promoters and those that are maybe not that good. And it also plays into what Jean-Pierre Mustier said, you know, presumably when his fund will invest in a company, you know, he will hope to bring something as a minority investor to that company, not just capital, but maybe expertise and experts and, you know, all these kind of things. So that sounds like a very good and, you know, positive hypothesis, of course, to be tested out.
Yeah, I think so. I mean, I think that it actually, you know, that you can't really understand these unless you believe that they are going to add some of that value, because otherwise it's just a negotiation. I just have to find somebody crazy enough to sell a company to me at 20, 30, 40% below the market value, which sort of doesn't make sense.
That's right. And I think people argued before, I mean, if you invest in the IPO, you can redeem, but then, you know, the next stage is really the one that's, you know, the people who come in with a pipe. I mean, that's the puzzling part. I mean, if you like.
That's right. I mean, this is new money, so there's no particular reason why they should come in and not do proper.
Anyway, I think, you know, we will have an interesting time trying to explain this to our students. I think we have some great material on the record for today. Yeah. So I think this, unfortunately, brings us to the end of today. I think you'll be on again tomorrow, Tim.
Yes.
I'll be handing over to Annette Pajust, who's here to take us through to the dual class shares. Now, of course, there's a link between the two, because I think, as we heard, what we're really trying to do is, you know, what markets and, you know, regulators are trying to do is they're trying to make markets more attractive for people to list. And maybe that does involve, you know, allowing new vehicles like SPACs. Maybe it does, you know, it does actually imply that you give them the control enhancing mechanisms that founders want. And, you know, the question we'll explore tomorrow is whether there is efficient contracting with institutional investors, because we know, and George Dallas was on the panel today, he couldn't speak, but he'll be there tomorrow, and I'm sure he will speak. You know, he's from ICGN, and ICGN members, International Corporate Governance Network members, they clearly don't like dual class shares. So the question is, where's the contractual failure here? Why do investors buy these things that founders might want, or I mean, do want, but, you know, some of the investors don't. So I think tomorrow is going to be another interesting day. So do join us 2 o'clock Central European summertime. It might not seem summer yet, but it is summertime. And let me just close by thanking all our presenters. Michael, thank you for joining from Stanford. This must have been the cheapest flight ticket that we ever had, so it's good. And thank you again to Oxera and to Latham's, and thank you to our panelists, and thank you to everybody else, and to Elaine and the ECGI staff, and have a very nice evening, and we look forward to seeing you back tomorrow. Thank you.